Hello everyone and welcome back to the channel. In this video I'm going to explain to you the basics of long put, long calls and short put and short call options, okay? And of course I'm going to explain to you guys the few things that you must take in consideration when you're placing your option trading, okay? I do not have any script here. It's pretty much top of my head. I've been doing this thing for too many years, so I know exactly what I'm going to talk about, okay? But the first thing first, you guys need to understand, it is, guys, the chart itself. Because the thing is, we're using here the SPY, by the way, which it is the ETF that tracks the S&P 500. So for whatever reason, for example, if you say that, oh, I think at this level here, we might have a support. That's fine. That's fine. Whatever you use in terms of technical analysis, fundamental analysis, if you're making money, great for you. I go more into percentage discount. That's why I have built my own indicator here, as you guys can see, and I have my levels here that I'm comfortable with to get into the SPY, no matter what happens in terms of indicators, fundamentals, whatever. Why? Because I want to hold this thing here for the long term, and the lowest it goes, the more I can buy, okay? But let's say, for example, you did your analysis and you said, you know what, I think the SPY will not go below this level here, okay, which is roughly $465. What you can do is, you as an option seller, you can buy a short put, okay, at this level here, okay? But if you are bearish on the SPY and you think the SPY will hit all the way down here, whatever time horizon it might be, you can buy a long put. If you think the SPY will not hit this level here, let's say 620, for example, in X days, it can be 30 days, 20 days, 15 days, you can sell here a short call. If you think the SPY is going to go from here all the way past here on X days, whatever DTE, days to expiration, you can buy a call option because you're going to profit on the stock rising, okay? So basically, it's very simple. If you open a short put, you want the stock to be, let's say, trading sideways or to go up. If you open a long put, you want the stock to go down. That's for sure. If you open a short call, you want the stock to trade sideways or to go down. If you open a long call, you want the stock to go up. As you guys can see, long put, long call, they are the opposite. Short call, short put, they are the opposite, as you guys can see, okay? Very, very simple. So basically, short put sellers making money on sideways, stocking going down a little bit, but not below the strike price, and going up. The long puts, people make money if the stock goes down, okay, past the strike price. The short call, all the way up here, you want the stock to rise a little bit, but not past your short call, and of course trade sideways or maybe go down. The long call option buyers want the stock to go up to pass the strike price so you can make money. Very, very simple, okay? So remember, for you to bet, whatever word you might want to use on those four scenarios, you must be bullish on the particular security. You must think the security will trade at least sideways, or if you think the security will trade down. Otherwise, guys, it doesn't make sense, okay? Because if you buy a call option and if this thing happen, you lose money. If you buy a put option and this thing happen, you lose money. If you short a put and this thing happen, you lose money. If you long a put and these two things happen, you're going to lose money. So very, very simple to understand, but of course, just the things that you need to take into consideration. So back here on our option chain, like I said to you guys, you must take other things into consideration. One of them, it is what strike price you're going to sell or buy your option, call and put, and of course your delta, which pretty much give you the pop in terms of making money, probability of profit, okay? And of course, in this side here, we have our days to expiration. Very simple. Let's say, for example, we're going to trade an option here with a 24 DT. What we're going to do is we're going to come here, we're going to open the option chain. If we were, remember, this is pretty much the market price, okay? Right now it's 571. Let's call this 571 dead on, okay? If we think the stock is going to trade sideways or go up, we're gonna sell a put option. Okay, if we think the stock is going down past our strike price, we're gonna sell here a short. We're gonna buy a long put. Okay, here we are selling a short put. If we think the stock is gonna go up past our strike price here, what we're gonna do is we're gonna buy a long call option. If we think the stock's gonna go up but ain't gonna pass our strike price or maybe trade sideways or down, we're gonna do a short call. Okay, so very, very simple. Ask yourself, are you bullish on the stock? Okay, this is what you need to ask yourself on your analysis, whatever analysis you might use. Or are you bearish on the stock? Okay, but the problem is, you can get your directions right. Let's say, for example, you bought a long put all the way down here. The stock can still go down and you can still lose money. Why? Because, guys, there's plenty of things. Time decay, which is one of the main things. And of course, we can still trade, let's say, above your strike price, and the option can expire worthless. That's why, for those of you as a beginner, you stick with option selling, guys, with the proper risk and trade management and position size. Okay? Anyway, I think in next days, in this case here, in 24 days, the stock don't gonna pass down below 560. What I'm gonna do is I'm gonna sell here one short put. As you guys can see, we are selling here -1 with 24 days to expiration, and this is the buying power for us to sell this option here on XPY. We're gonna collect $3.25 because each contract hold 100 shares. We are going to make $224 per contract. Okay, if you trade 2, 3, 4, you multiply this by 2, 3, and 4. Very, very crucial that you do understand. In our pop here, it's 89. In other words, we have 89% of profit the day we place the trade. Okay, but if we think the stock's gonna go down all the way past here, let's say 516, whatever how many days we might trade, in this case here, of course, 24 days, we're going to buy this $560. Of course, because you're buying the option, the maximum loss always is going to be equal to the premium. The same thing the option seller. Option seller, the maximum loss or maximum gain, it's always capped by the maximum premium collect. In this case here, as an option buyer, we always gonna have the maximum loss equivalent to the premium we pay to open this trade. In this case, one contract, 24 days to expiration, and of course the buying power, because it is our maximum loss, there's no risk to the broker here for us to blow up this account more than we should. Why? Because we should lose only $325 on this trade. Okay, very, very simple. The same thing apply on the upside as well. If we come here, for example, if we think the stock ain't gonna trade above $580, we can sell here $580 strike price, 24 days to expiration, one contract, and this is how much the broker is gonna ask us in terms of the option buying power. And like I said before, we're going to collect the mid price here of $3.40, which is gonna give us $340 for this trade, and this will be the maximum gain for the call option seller. But of course, theoretically speaking, the stock can goes up to infinite, so your loss here, guys, it is infinite. That's why I do not suggest you guys trading short call if you don't have experience enough. Of course, if you want to trade something even better, guys, you can do a strangle, okay, holding the shares, because every time the stock price goes above here, it get canceled by the gains on the shares. That's why strangle it is, guys, the best one to do if you want to trade call options. Okay, of course, I'm talking about here for those of you that start to trading, why now? Okay, but if you think the stock will pass $580, what you can do is, if you are very, very bullish, whatever reason might be, on this time horizon, don't forget, if the stock blow up above 580 in 21 days, it's too late. Even by then, you're still losing money, because if the stock keeps trading sideways, and we have here, let's say 5 days to this 24 here to expire, let's say after 19 days, for example, if it's trading the way up here, this 340 here, guys, might only worth $1. okay, and that'll be very hard to recover. That's why it's very hard to make money as an option buyer. But in this case, again, like we saw in the put option, your maximum loss is $340, okay? And if you guys can hear something on the back, it's just people checking our fire alarm in our building, okay? Again, maximum loss $340, buying power very low. Why? Because that's only the risk the broker have in relation to your trade, which is $340, one contract, 24 days to expiration. Very, very simple, okay? But of course, this is what means short put, okay, long put, short call, and long call option, guys. In a nutshell, very, very simple to understand. But of course, if you want to master the in and outs when it comes to trading options, you must understand, guys, delta, option interest, and very, very crucial, of course, liquidity, when to manage and when to close, all those good stuff, how to roll your option. Because the thing is, the more you know how to manage your trades, okay, the less you're going to lose. Why? Because the dangers when it comes to trading options are on the things that you don't know. If you know how to manage your trades, especially before you press the trigger, watching your position size, as an option seller, you'll be doing yourself a massive favor, especially for those of you option sellers that your loss sometimes can be infinite or can be massive. Well, option buyers, you know exactly at the beginning how much you're going to lose, which it is your premium that you're going to pay, which it is your buying power required at the beginning. But the option sellers, the broker might ask you to put up front $1,000, but your risk here might be 100K, okay, or maybe 200K. Okay, so that's the thing you need to understand. But of course, there's plenty of videos in my channel you can go and improve and learn yourself. Okay, guys, thank you very much. In a nutshell, this is what I mean: long call option, long put option, short put option, and of course, short call option. Okay, if you have any question, leave your comments below and I'll get back to you as soon as possible. All the best, stay safe, and happy investing.